Okay, so let's start. We will start by basically just revising a little bit what we have done in our last class. And in the last class we have covered the chapter 3 of this Brealey-Myers book. And we said there are basically some very, very important things in this chapter. The first conceptual thing is that we can actually add present values and that this makes sense. It makes sense to add present value. Why? Because you are indifferent between $100 today and $100 today. It's a simple concept, but it gives a rise to the powerful phenomena that you can actually add present value. Unlike adding $100 today and $200 in a year from now, it's not $300 today. It's something different. So we said we can add present values and it makes sense. Now we said, okay, there are some very special cash flow streams, and we have learned and derived formulas to calculate present values of these very special cash flow streams. And we said one very special cash flow stream is called perpetuity. It's a cash flow stream that pays you a constant amount of money each period of time from the next period till the eternity. But the timing is here important. That the first payment, actually it's important for our formulas to work. It's important that the first payment starts in a period from now and then it continues till eternity. The special cash flow stream number 2, we called it annuity. It's very similar to perpetuity, but it pays for some specific number of times. It pays for T number of times. For T periods of times, it will pay you exactly the same number. This C could be $100, $1,000. And we said this one is especially useful because this looks very much like any loan. Any loan will look like you have to pay constant amount of money every month. And we saw in the last class how using the special formula that we have derived for this annuity, how to calculate, for example, how much per month do you have to pay to your bank if you take, I don't know, $500,000 credit for a house. How much monthly do you have to pay in order to repay this debt to your bank? How much your bank will ask you to pay monthly? This is what we have seen last time. We have seen that by using the present value formula of the annuity, this is basically a trivial task. Then we talked a little bit about the constant growth perpetuity, which, unlike annuity, it doesn't pay you constant amounts of money each period of time. It pays you increasing amounts of money each period of time. And each period, it pays G% more than in the previous period. So in period C8, it would pay you 10% more, for example, or G% more than in period 7, while period 7 would be 10% more than period 6. And we talked about the constant growth annuity, and we said that this is also very similar like this perpetuity, but unlike the perpetuity, it pays for some specific number of periods. It doesn't pay until eternity, it pays for some specific number of periods. Now, let's put all this together and revise and try to understand again the timing of the cash flows and how much money they are worth today. So, we said for the perpetuity, and only for the perpetuity, whose first payment is in one period from now till eternity, the present value will be given by C over R. So if you receive $100 every month from the next month till eternity, this would be equivalent if I give you today 100 divided by R amount of money today. You would be indifferent between these two things. Why? Because if you put amount of money C today in the bank with the interest rate R, you would be able to replicate, in a sense, this cash flow stream. But pay attention. The timing is important here. So first payment takes place in a period from now. This can be month, but if it's a month, then this R is a monthly rate. If it's a year from now and it pays every year, then R is a monthly rate, annual rate if it's every year. If it's month, then R is monthly rate. If it's daily payments from tomorrow till eternity, and every day you receive amount of C, then your R should be a daily rate, not the annual rate. And the important thing is it starts in a period from now. Then this formula works. If it starts in 10 periods from now, let's say R is expressed in annual percents per month, per year. This is why it's annual. Then if it starts 10 years from now, then it's not anymore C over R. This will be C over R looked from the perspective of year 9. So you would have to discount it additionally. So for the annuity, this is we said, this is probably the most useful for the everyday life when you want to calculate what's the value of your, how much you should pay for the loan monthly, for example. Then this is the formula that is very useful for you. We have derived it. This formula didn't came to us from a book. We have derived it. We know how to come to this formula, C over R minus C over R over 1 plus R to the power of t. And again, it's very important that the first payment is in a period from now, not today, and the last payment is in t periods from now, not in t plus 1, not in t plus 2, in exactly t periods from now. Okay. Now, but we said for the constant growth perpetuity, the things are a bit more complex. And actually, constant growth perpetuity will have some present value in finite present value only if and only if growth rate is smaller than the discount rate. And we said if the growth rate is smaller than the discount rate, then constant growth perpetuity will be worth C1 over R minus G. And it's important again, then this first payment, C1, takes place in a year from now, or in a month from now, or in a day from now, not today, not in 10 years from now, not in 10 months from now, but one period of time from now. And it grows until eternity at the rate of G. If this G is smaller than R, then we can calculate the present value by C1 over R minus G. But pay attention, this is not C over R minus G. There is no C when we talk about the constant growth perpetuity. Every C is different. C1 is different than C2, than C3, than C4. They grow at the rate of G percent per year, or per month, or per day, depending how it's expressed. And we said if G is larger or equal than R, then present value of this constant growth perpetuity is infinite. And why is that? We said if you have a geometric series, if you have 1 plus x to the square plus x to the third until eternity, this thing will be a number only if x is smaller than 1. So for example, 1 half. 1 plus 1 half plus 1 half to the square plus 1 half to the fourth to the third, etc. is 1 plus 1 half plus 1 fourth plus 1 over 16. This all adds up to 2. But if it's 1 plus 1 plus 1 plus 1, this is infinite. This does not converge. So we said if G is larger or equal than R, then this does not converge. This is infinite amount of money. Unlike for the constant growth perpetuity, for the constant growth annuity, so you have fixed number of payments. It's 10 payments, it's 100 of payments, it's 1 billion of payments. It doesn't matter. Whatever the growth rate is, this will be a finite number. This will be just sum of some numbers. And these numbers are numbers which you can add together, and you end up, when you add numbers together, you get a number. But if you add infinitely many numbers together, then it depends. It might be infinite or it might be not infinite. Then it depends. But in this case, it's always finite number, and we have derived the formula for that. Okay. Now let me try to give you an example from the exam. Example from the exam. People consider this probably the toughest exercise on the exam every year. And in your third class, you already know how to solve it. You already know how to solve this. And the only thing that you need to understand is how discounting and basically counting dollars works. What I have told you in the first two classes, in not more than, when you talk about mathematics, you learn there how to count numbers, add numbers, and stuff like that. Here, you learn how to count dollars. And this is only thing that you need to know to solve this exercise. So I give you the following cash flow stream. This is just a normal cash flow stream. Today you invest $1,000. In year 1 you get back $30. In year 2 you get $30. In year 3 you get $30. In year 4 you get $33. And then every year until year 19 you get $33. And then later until eternity you get 10% more. And then I ask you, the first question is, if your opportunity cost of capital is 7%, what does it mean? If you are considering, should I invest into this project? Because, you know, every investment, in a sense, can be represented as some cash flow stream. Should I invest into this, or should I invest at the 7% rate? I just buy some, I don't know, bonds, or I give it to the bank that offers me 7%, for example. Now, I ask you the following. I ask you first, could you please tell me what is the present value of the first 3 cash flows? The cash flow in year 1, cash flow in year 2, and cash flow in year 3. So you say, okay, this is like a little annuity. This is 30, 30, 30. And I can calculate it in 2 ways. I can calculate it using the annuity formula, or I can just easily calculate this cash flow for period A, which I call just by discounting each cash flow with the corresponding discount factor. And that's it. This is basically it. This is the answer for the first part of the question. And you already know how to do this. We have done a couple of examples like this one. Then I ask you, okay, but what is the net present value of the cash flow stream that, let's call it period B, from year 4 till year 19, both included? So year 4 included, year 19 included. So you can say, okay, I can do it in the same way as above. So I can say 33, which I receive in year 4, discounted by 1.0.07 to the power of 4, plus 33 discounted by 1.0.07 to the 5th, etc. And you have to add these 16 numbers together. But this is a complicated and it will take you some time. You can then say, okay, but I can use my annuity formula. So if I stand in year 3, if I'm in year 3, just imagine, now it's year 3. This looks just like a normal annuity. First payment starts in a year from now, and then it continues for 16 years. From the perspective of year 3. From the perspective of year 0, this is not a normal annuity. It starts in 4 years from now and ends in 19 years from now. But from the perspective of year 3, it is clear. This is a simple annuity. Starts in a year from now and goes for 16 years. So I can use the annuity formula. C over R minus C over R times 1 over 1 plus R to the power of 16. Because looked from the perspective of year 3, this last payment is in year 16 in a sense. And now, if you calculate this thing in the big parenthesis, this is how much cash flow B is worth from the perspective of year 3. And how much is that worth today? Well, you have to discount it for 3 years, because this is how much it is worth. This thing in the parenthesis is how much it is worth in year 3, and any cash flow in year 3, in order to calculate how much is it worth today, you have to discount it with 1 plus 0.07 to the power of 3, with the discount factor for the 3-year cash flow. Any questions for this? Okay, now I ask you, okay, could you please tell me, what is the present value of the cash flow stream that starts in period 20 and then goes till eternity? And then you can tell me, okay, from the perspective of year 19, this looks like a constant growth perpetuity. And we have said, if G is larger than R, then the present value is infinite. Why? Because it grows faster than you discount it. So present values are growing over time, not decreasing. And therefore, present value of cash flow C is infinite. So what's the total net present value? Well, this is present value of A plus present value of B plus present value of C minus 1,000 that you pay in year 0. But this is infinite because present value of C is infinite. Okay? Now I can ask you the following thing. But what if, unlike in this case, we had the growth rate of 10%. Now we have the growth rate of 5%. Well, now the cash flow stream in year 20 is not anymore 10% larger than the cash flow in year 19. It's only 5% larger, making it 34.65. And the next cash flow stream is not 10% larger, it's only 5% larger, and it's 36.38. Now, the question is, what are the present values? Well, present values for the first cash flow stream does not change. It's exactly the same. Nothing has changed. Cash flow stream 2, cash flow stream B, nothing changes. But the cash flow stream C is now different. Now it has some finite value. It has some value. It's not infinite. It's not infinite amount of money. It's some amount of money. How much? Well, from the perspective of year 19, this looks like a constant growth perpetuity. What does it mean? It means that we can use constant growth perpetuity formula to determine how much this is worth in the year 19. So how much is this worth in the year 19? Constant growth perpetuity formula tells us C1 over R minus G. So in year 19, this would be 34.65 divided by 0.07 minus 0.05. This many dollars. How much is that worth today? Well, you have to discount it with the 19-year discount factor, because from the perspective of year 19, this is just a constant growth perpetuity. Okay? It's the same case, very similar to what we have done here. So from the perspective of year 19, you have a first payment of 34.65, and then 5% more every year. So it's just a constant growth perpetuity, nothing more than that. And you calculate it, and then I ask you, okay, what is the net present value of all this? Well, you can calculate it. Just add these numbers together.
Are the slides differ here?
Okay. Now we know what kind of complexity probably one of the hardest exercises in the exams will be. It will be something similar to this. I want you to know to calculate present value of any cash flow stream that I can throw at you. This is like adding numbers in math. If you don't know how to add numbers, you know nothing from math. Like with finance, if you don't know how to count dollars, you know nothing from finance. This is the most important thing in this class. You have to learn how to count dollars. How much is this worth? Because you know, if you look at this cash flow stream, I mean, these are just some numbers on a paper. But you know, this can be a revenue of a company. This can be a loan. This can be whatever. I mean, this is how things look like in real life. In real life, when you are asked to, what is the value of this? They tell you, okay, let's construct a cash flow, and then let's value this cash flow. And this is how you do it. And this is why it's so important to know it. And I mean, you know, I believe that everybody, as I told you, should know how to do this kind of stuff. If you go to a bank and ask for a loan, how much do you have to pay? How much is your bank charging you? I showed you in the last class that, you know, it depends. When they tell you we charge you 5% interest, it depends on how often, how frequently they compound. You have no idea until they actually tell you that how much you will pay at the end. And banks are using these kind of tricks, you know, they tell you one rate when it's more suitable for them, the other rate when it's more suitable for them. They will tell you different rates all the time. And you really have to understand how they calculate things in order to be able to tell how much you are going to pay. Okay. Now we move to the chapter 4. And in this class, we should understand how do we use just this simple technique of discounted cash flows. How can we use it to determine what are the prices of bonds? But before we start with that, let's see what are bonds. Now you remember the example from our first class. I told you, you have this Dutch East India Company. And this Dutch East India Company needs to construct some ships and send them to India to buy spices, bring them back, and this is what started the revolution, this limited liability thing. Some people invest into this company, they cannot lose more than they have invested, they don't guarantee for this investment with their houses, so they invest $10 million of their money into this company and they become equity holders. What does it mean? That means that they own part of the company. So every part of the company, so let's say this company has $10 million of assets. What are assets? Assets are basically, everything that company owns. And these people, these equity holders, own everything. And now imagine that this Dutch East India Company wants to build another set of ships. They need another set of ships, and they need to raise money somehow. And we said, financial manager of Dutch East India Company should go to capital markets and somehow obtain money for this investment. There are a couple of ways how he can do it. One way is to say, okay, I need $5 million, and I know the following. I know that currently this company has 1 million shares. It's split in 1 million simple pieces. And the price of each of these pieces is $10. That means that this company is worth $10 million. Now, what he can think of is, okay, let's try to sell more. Let's try to sell more pieces of this company. Let's create new pieces of this company and sell it to new investors. And these investors, they will say, okay, I will invest money into this company, and I become owner of this company also. So I own small piece of this company. And for owning this small piece of a company, I expect some part of the profits of this company. I take risk on myself that I will lose this money that I have invested, but not more than that. I risk only things that I have invested. But in exchange, I request that we share profits. So, how does it work? They issue a new 500,000 shares and they sell them for $10 per share. Let's assume that they can sell it under this price for a second. And then at the end they end up with 1.5 million shares. This is one way how can they do it. We'll talk much more about that when we talk about stocks. But now there is another way how company can finance this operation. So, let's imagine we have exactly the same situation as before. So we have this company which is worth 10 million, and every part of this company is owned by somebody. And now they want another 5 million, they need another $5 million in order to invest into new ships. They can go to a bank and they can say, okay, dear bank, can you give me $5 million? And bank will tell them, okay, sure, no problem. But you will have to pay interest on this $5 million. So bank does not become the owner of this part. They just borrow the money, they lend this money to them, and they expect some interest. But there is another way how you can raise money as debt, and this is to issue bonds. And this is how bonds used to look like. One bond would have this, you see this upper part, this upper piece. This is what is called the face of the bond, because usually there was a face, and this is actually a U.S. government bond from a long time ago, which had a face value of $1 billion. And these small pieces over here, below the face, are what is called coupons. And if you look carefully, you will see that there are tiny holes here, so you can easily kind of take the piece out of this bond. And for example, each piece of this bond would be worth some number of percents of the face value. For example, this is 1% of the face value. And then every month, if you own this bond, you go to the person that issued this bond, you give them the small piece, and he gives you 1% of what is written on the face value. And in the last period of time, let's say that this bond matures in 10 years from now, in the last period, you give him the face value plus the last coupon, and he gives you what is written here, $1 billion, plus this 1% for the last coupon. This is another way how you can issue debt. And you are not owning this company if the company issues a bond. You just get the interest on your investment. So let's understand how this works in slightly more details. Imagine that this is the US government, and you know, governments usually finance their operations, they gap in money that they have, so they gather money from taxes, but you know, they don't have money now, they need to pay for to fix some road. So they issue bonds, and in exchange for these bonds, they get money from people that buy these bonds. So this is how it works. This is the US government. They want to, I don't know, build a new spaceship, build a new warship, build a road, and do whatever. And imagine that this is you. And US government tells you, okay, dear you, I will give you today this piece of paper on which I have written, then in 1 year from now, I will give you $1,000. And you say, no problem, for this piece of paper today, I am willing to pay you $950. So today I give you $950, and you promise that in a year from now, you will give me $1,000. So what happens? Time goes by, 1 year passes, you take this paper, you knock at the doors of your government and tell them, okay, can I get my $1,000? And they tell you, sure, you get back your $1,000. And now, what's the idea? Government will always give you back this $1,000. Why? Because they know if they don't give it to you, you will tell to everybody that they didn't give you this money, and then nobody would give the money anymore. And you know, usually government bonds are considered riskless. The government will always give you back this money. And why is it like that? The point is they can always print money. They hold the money printing press. But you know, there are some special situations where this is not true. Like currently, if you observe, I mean, unless you lived on Mars for like last 2 years, you haven't realized that some governments are having problems in repaying their debt. Like, for example, Greek government or now Italian government. They have issued so many of these bonds that they cannot pay these bonds back from their taxes. And the problem is, they don't hold the printing press anymore. They have entered European Monetary Union. They cannot print euros that easily. They have to knock on the German door and ask them, can we print a little bit more money? And Angela Merkel said them, no, you cannot, because then my money will be worth less. I don't have problems with repaying my debt. And this is the issue. This is the same situation in which Argentina was a couple of decades ago, when they had a problem that their government, you know, they were issuing first bonds in Argentinian pesos. But you know, Argentinian pesos was something that was losing on the value a lot. It was just, you know, it was worth $1 today, and then you needed like 100 pesos for $1 next day. So nobody wanted to buy government bonds denominated in pesos. So Argentinian government said, okay, let's issue government bonds in US dollars. And they did so. And people bought these government bonds. But then, a couple of years later, when they need to give back money to those people that bought this bond, they realized, okay, we don't have this many dollars to give. And we cannot print US dollars. The problem is Argentinian government cannot print US dollars. Somebody would get really angry in the US if they did so. And this is exactly what we are observing currently in the EU. Greece cannot print euros that easily. It's not an option for them. And this is why everybody is talking. Maybe Greece will exit European Monetary Union, because if they exit European Monetary Union, they can easily print their money and repay their debt. Yes, this debt will be worth less, but that's the problem of the people who invested. But they at least would have a solution if they were able to print money. Now they don't even have a solution. They just don't have money. And you know, if they don't repay to these people money back, nobody will give them money ever anymore, because they know these people don't give their money back. It's as simple as that. Okay. Let's move from the contemporary politics to the topics in the book.
But if they give you, like, investors say, okay, that's he's giving me the entire money back, which is owing me, that's okay. But at that point, if I'm printing money, my money is worth less.
Yes.
Maybe as much worth as it was yesterday when I invested.
Yes, that's true. But you know,
So if the investor can tell that easily others too, and then
yes, this is
problem.
yeah. this is true, but it's not the same problem. And you know why it's not the same problem? I mean, the situation is a bit more complex. Imagine that you are running, people, just keep the noise. I really have a bad sore throat, and it's difficult for me to talk, and when I have to yell, it's even more painful. So imagine that you are in a situation of a country that has to pay salaries, that has to do lots of things. And you know, they cannot print money. They have to pay them 5 euros per head. For example, average salary is 1,000 euros. They have to give 1,000 euros to every employee, to every guy receiving pension or what. And now, what would Greek government have to do? They would have to say, okay, I cannot pay you these salaries, for example. And then they would have to renegotiate. You know, I have in my contract that you will pay me this. So they have to renegotiate with me. They have to renegotiate with you. They have to renegotiate all the salary and pension contracts in the country. This is very, very difficult. You know, people end up in streets doing protests and stuff. I don't want to renegotiate. Who are you to renegotiate? I have it in my contract that you will pay me this amount of money. But you know, if I can print money, yes, this is like an automatic renegotiation of all contracts. All contracts will be worth less simultaneously, but at least I have a method. And you will learn later in managerial economics that this is actually not the same. That this is not the same, that there is a cost in renegotiating things. There is a cost in negotiating things. So this is not the same if you make your money less valuable, or if you renegotiate all the salaries and all the salaries become cheaper 10%. There is an implicit cost there which should be taken into account. So this is not the same. It's very similar but not the same. So as we said, every bond before, long time ago, looked like this. It had the face value and the coupons below. Currently, I mean, you don't even see the bonds. They are somewhere in the computer. These are some fields in some database in a sense. You don't see them. You call your broker, you tell them I want this bond, and you don't even see this piece of paper. But every bond still has a face value. Some people call it par value. And it has coupons. And coupons are usually expressed as a number of percent of the face value. Now, often these coupons are paid semi-annually and not annually. So what does it mean? That means if the 10% coupon is paid semi-annually, that in essence means that every 6 months you receive 5% of the face value. So this bond, $1,000 face value, 10% coupons paid semi-annually, that means 5% every 6 months, and at the end you receive the face value plus the last coupon. And you know, this is just a cash flow stream. And it's actually a simple cash flow stream. And now if I would ask you, how much money makes you indifferent to this cash flow stream? And you can immediately tell me, this is just the present value that we have taught. So I would be willing to pay for this at most this amount of money, not more than that. But also you as a seller, you're not willing to sell it for less than this amount of money. So this must be the price of a bond. And actually it turns out that prices of the bonds are really, really close to the prices that you get by discounted bonds cash flow stream. If you check you go to Yahoo Finance, Google Finance, check prices of bonds, try to discount them with these methods that we have learned in the class, and you will get exactly those prices that you observe in the markets. Okay, let's see one example. Imagine that you have a bond issued by IBM. So IBM wants to expand its operation and it needs money. It issues bond. And you know, every company, at least among these big corporations, that they have some ratings. They are somehow rated. And typical rating for a good standing big corporation is AAA rating. That means that this is a very safe company to invest. And for example, you take the Wall Street Journal or you check it online, you see what is the return that you can expect to get if you invest in a company with the same rating. So you can check actually what is the return, what other companies, what other corporate bonds of corporations with same risk rating give you. And you check this is 7.5%. Then you do the following. You say, okay, how does this cash flow stream looks like? In 2012, I get $115. In 2013, I get $115. In 2014, I get 115. In 2015, 115. And in 2016, I get the face value plus the last coupon. And now the question is, what is the price? How much would I pay for this bond? Well, you know that you will certainly not pay more than this amount of money. Because if you invest this amount of money in something, if you invest $1,161.84 into something that is of a similar risk, something that is AAA rated, you will get more. Basically, so you don't want to pay for this more than this amount of money. This is out of the question. By investing this amount of money at this rate, you will be able to replicate this cash flow stream. That's clear as that. Okay. Now what we can see from this chart is that price of a bond depends with which interest rate do you discount it.
I've got one question that says if it's October 1st, 2007, should it be 2011?
Yeah. In the previous slide, I think it's correctly written. So it's October 1st, 2011. So in this slide, it should be October 1st, 2011, and not 2007.
And September 2012.
Yeah. Exactly. So the text is the correct in the previous slide. Here, there is a mistake. Sorry for that. Okay. So, from what we can see from here is that price of the bond, present value of the bond, depends on few things. It depends on the cash flow stream, but you know, this is something that is written in a contract of a bond. This does not change with time. You will get these coupon rates that are written there, you will get this face value that is written at the beginning of the contract. But what changes over time is interest rates in the market. Because, you know, imagine I tell you, how much are you willing to pay for this bond? You say, I don't know, some amount of money. And this demand, you know, as there are more people interested, prices go up and they change interest rates in the market. We'll observe that a little bit later. But the idea is, let's check what happens with the bonds when interest rates change.
The cash flows actually issued before I invest. Like, do I know the cash flows or the interest rates for each year? Like,
You know everything. I mean, everything is written in a contract.
yeah, that would be my question.
Yeah, everything is written in a contract. There are no hidden things in the cash flow of a bond. Everything is written in a contract. So imagine that you have the following bond. It's a zero coupon bond. It means it pays you no coupons. It pays no coupons. It just pays you a face value, and in this case, it matures in 2 years. So in 2 years from now, this bond will give you $1,000. So what does it mean? It means that the cash flow of this bond is very simple. It's like this. Today, nothing. In a year from now, nothing. And in 2 years from now, $1,000. Now I ask you, if the interest rate is 10% per year, what is the value of this bond? And you tell me, well, that's easy. I just have to discount this. This is 1,000 divided by 1.1 to the square, which is $826. So for this bond, you would not pay any more than $826. Now, but imagine that the interest rates are not 10%, but they go up. They go to 15% per year. What is now the value of this bond? Well, when interest rates go up, it's obvious from the way how we calculate the price that the price goes down. And we get to some other number. We get to $756. Now, but what happens if the interest rates go down from 10% to 5%? Well, then the price goes up. I mean, this is just how price of this bond has changed with the different interest rates. Now, let's do a small calculation. Let's see how much our price has changed in percents when the interest rates have changed. So in the first case, we are asking ourselves, okay, what if interest rates go up from 10 to 15%? What's going on? Well, at the beginning, price was $826. At the end, it was $756. So what is the return on this? How much did the price change? Well, price decreased for 8.5%. Basically, $756 is 8.5% less than $826. Now, let's do the same exercise for the other case, when the interest rates go down. So we observe the increase of 9.8%, because $907 is 9.8% more than $826. That's clear. We are observing for how many percents price of a bond has changed when the interest rate went up or down 5%. Now let's do the same exercise for the bond, which is exactly the same. But unlike this bond, matures in 4 years. So it's just a slightly different cash flow stream. It gives you the face value in 4 years from now. So we repeat exactly the same steps. Was the price at 10%? We discount it with 1.1 to the power of 4, because the last payment is in year 4. What happens if the interest rates go up for 5%? Well, we again calculate the price. We again calculate the price if the interest rates go down for 5%. And now let's observe these percentual changes for this bond with the same changes in interest rates. We observe that when the interest rates have went up, we observe the decrease of 16% in the price of the bond. When interest rate went down for 5 percentage points, we observe increase of 20%. So this is for the 4-year zero coupon bond. But now if we observe the same thing, what we did in the previous slide for the 2-year maturity, we observe that these changes are smaller. Both of them are systematically smaller. 9.8 is more than 20%, 8.5 is more than 60%. So what we have learned from these two simple examples, we have learned a couple of things. We have learned, number one, if interest rates go up, then bond prices go down. This is a general rule. If interest rates go down, prices of bonds go up. And if we have two exactly the same bonds, just with different maturity, then the bond with longer maturity is more sensitive to changes in interest rates. Now, why would anybody be interested in sensitivity of a bond to changes in interest rates? Now, let me try to explain this. Imagine you are a government, you are German government, or you are the US government, and your country is currently in economic crisis, and the world is currently in economic crisis. And governments want to motivate people to invest more into economy, to take their investments from government bonds and invest more money into economy to help economy grow healthy again. So how do they do it? They have various methods to decrease interest rates. Imagine if your government offered you, if you give me $100, after 1 year you will get for sure 10% more. You would invest into it. But what if your government tells you, if you give us money, $100, and we offer you only 0.5% per year, which is approximately what you can get in today's market, then you would say, well, 0.5% per year, this is really low. Let me better invest into some stocks. Let me better invest into IBM. It's riskier, but it offers much more of a return. So governments try to keep the interest rates down when the crisis strikes, so to motivate people to move money from government bonds to the real economy. But there is another downside there. Whenever government changes interest rates, value of a bank is changing. Any bank is nothing else but a giant cash flow stream. You know, bank has invests money into bonds, gives loans, takes loans. I mean, basically, it's just a giant cash flow stream. Every loan is a cash flow stream. Every bond is a cash flow stream. And when you add all these things up, you will just get one giant cash flow stream. And it's actually not a huge cash flow stream. Because, you know, bank will rarely give you a loan for more than 30 years. It will rarely invest into bonds with the maturity of over 30 years. Basically, these bonds don't even exist. So, if you can draw a cash flow stream of a bank, and you can do it, you know, they have payments every day coming and going, and the net of these payments is just one huge cash flow stream every day for 30 years. Not more than that, so it's not really that huge. I mean, this is like 30 times 365. This is like, I don't know, 7,000 numbers. Every bank can be represented with 7,000 numbers. So in a sense, it would be equivalent for you to be owner of the bank or some series of 7,000 numbers. Every bank can be represented like that. And now government, when they change interest rates, they implicitly change the value of whole bank. Because, you know, value of this cash flow stream depends on which rate you will use to discount it. So in a sense, government can change value of the banks just by changing interest rate. And now the problem with the banks is, you know, if government tells us, okay, let's shut down Rewe supermarkets. I mean, nobody except employees in Rewe supermarkets care. They will be out of the job, and that's it. You will still continue shopping in Aldi or wherever. But if bank tells, by changing in interest rates, creates such a situation when Deutsche Bank dies. Deutsche Bank cannot survive this change in interest rates because, you know, their present value just melts. They just kill the bank by changing interest rates. What happens then? It's not only that owners of the Deutsche Bank are affected. Everybody basically who has their money invested in a Deutsche Bank is affected. You know, I don't know, Mercedes-Benz keep their money with the Deutsche Bank, and now government kills Deutsche Bank. Mercedes-Benz also goes down, I mean. Of course, they are diversified, etc., but many are not, especially small firms. I mean, they have bank accounts only in one bank. And if government kills that bank by changing interest rates, they have killed many jobs. And if they kill many jobs, they lose elections. And they don't want to lose elections. I mean, optimization function of every government, they want to win the elections. It's not I want to make economy better and stuff. They just want to win elections. So every bank, every government is interested in the fact that will changes in interest rates kill some bank. So if you end up working in a bank, in a risk management department, or in a department that reports to the government, you will be asked, okay, how will this influence our bank? How this changes, how are we sensitive to changes in interest rate? Because, you know, if Deutsche Bank would be killed by, I don't know, increase or decrease of 1% in interest rates, you know, president of Deutsche Bank would for sure go to Angela Merkel and say, whoa, don't do that, you will kill us. And Angela Merkel will say, okay, I won't do it. Because, I mean, politicians are not stupid. They understand these kind of things. So, but the problem with this concept that we have derived so far, we know only that having two equal bonds, just with different maturity, the ones with the longer maturity are more sensitive to changes in interest rates. Now I will show you that this doesn't hold for every bond. So let's do the following example. You have a 1,000 US government bond with 40% coupons paid semi-annually. So what does it mean? That means that every 6 months you get $200. And this 2.48%, pay attention, in this example, this is semi-annual rate. This is not an annual rate. Because if you look how we discount this cash flow stream, you will see that payment that arrives in 6 months, we discount with 1.0248. The thing in a 1 year, so this is year 1 from now, this is not 2 years from now, we discount with 1.248 to the square. The point is, this is a semi-annual rate. This is what you get after if you invest for 6 months, not an annual rate. Okay, now if this semi-annual rate goes down to 1.5%, what happens? Well, we can again calculate the present value. And what happens with the percentual change in price? Well, we observe that if interest rates go from 2.48% to 1.5%, we observe the increase in the price of this bond by 5.6%. And this is a 4-year bond. Now let's do this exactly the same example, but with the 1% coupon bond. So if you observe this 1% coupon bond, which matures in 3 years, what does it mean? Semi-annual coupons, that means that you receive 0.5% every 6 months. And if the 6-month rate, this is not 6-month annual rate, this is 6-month rate, this is what you get after investing money for 6 months, is 2.48%, then you get this value. If it goes down to 1.5%, you get this value. So instead of $890, price goes up to $943. Okay, so how much, in this case, for how many percent did the price of this bond change? Well, we observed the increase in price of 5.9%. And observe, this is a 4-year bond. This is a 3-year bond. And you know, it's more sensitive to the changes in interest rates than the 4-year bond. And we said, but pay attention, we said everything else equal, 2 bonds, the one with the longer maturity will be more sensitive. But these bonds are not the same. One has 40% coupons, one has 1% coupons. So what's the idea here? Well, we have to come up with the measure that will help us measure which bond is more sensitive to the changes in interest rates. And I told you why is this super important. Because you want to know how your value will be affected by the changes in interest rates.
How do you get the 5 there?
5 there, you know, these are 1% coupons paid semi-annually. That means 0.5% paid every 6 months. I mean, I'm intentionally saying this because this is how usually bonds are quoted. If you go to the stock market, US bonds usually pay semi-annual coupons, and they are quoted like this. They tell you this is a 10% semi-annual coupon. That means 5% every 6 months. Okay, so now we come to the measure that will help us to measure how bonds are sensitive to the changes in interest rates. And this measure is called the duration. So this is the same bond from the first example. So from the first example, we know the following. These are the time periods when we will receive some payments. And these are the cash flows that we will receive in each of these periods. In 6 months, we will receive $200. In a year from now, you will receive $200, etc. In the last period, you receive the face value in the last coupon. Now, what is the present value of each of these cash flow streams? We can calculate that easily, and this is what we have done. So the first cash flow stream, because this is a semi-annual rate, will be 200 divided by 1 over 200 divided by 1 plus 0.0248. And this will be equal to 195.16. Then what you receive in year 3, this 172.66, you get to this number by 200 divided by 1.0248 to the power of 6, not to the power of 3, because this is semi-annual rate. I mean, you have how I calculate the present value of this cash flow stream 2 slides back. So what's the idea? Now let's calculate how much are these present value of each this cash flow. How many percent is that of the total present value? So now the last number in this column, 43.7%. That means that 43.7% of the present value of the bond, of the total present value, is received in the last period. This is basically, this 43.7 is equal to 986.43, which is the present value of the last payment, divided by the total present value. This is simple. This is a percentage of the total present value that you receive in every period. And now you multiply these numbers by the corresponding time period. So this 1.75 years is basically this 4 times 0.437, and you get 1.75. So this is some number of percents time the year. This is expressed in years. If you add all these numbers together, you end up with 2.85 years. This is the duration of this bond. And now you will see many different definitions of the duration. But the one that I like the most, and that is actually the correct one, is that the duration of a bond tells you that this bond is approximately sensitive to the changes in interest rates as the zero coupon bond that matures in the duration years from now. So this bond will be as sensitive to the changes in interest rates as the zero coupon bond that matures in 2.85 years from now. Okay, now we can repeat exactly the same mechanics in a sense. I mean, this is just multiplying and adding numbers, and it's not that complex. Let me repeat. You calculate the present value of each cash flow. You calculate how much is that of a total present value. You multiply that by the time period that this cash flow takes place. You add all this number, and this is the duration.
What does that mean, the duration is? I didn't get that.
Let me repeat. That means that this bond is as sensitive to changes in interest rates as the zero coupon bond that matures in 2.85 years from now. So bond that doesn't pay any coupons, that has just one payment in 2.85 years from now. But we will see actually what this number means numerically. What we can do with this number we'll see just in 2 slides from now. Now let's repeat this exercise for the 3-year bond. We have observed that this 3-year bond is actually more sensitive than this 4-year bond that I have showed you. I showed you that if interest rates change here in the same way as for the previous bond, price of this bond will change more. So it should have higher duration. And actually, if you repeat exactly the same thing for this bond, exactly the same thing, we will get to the duration of 2.96 years. So this bond is as sensitive as the bond that has no coupons but matures in 2.96 years. So we can compare now these two bonds. We can say this one is more sensitive because it has higher duration. But pay attention, this is an approximate measure. This measure tells you how sensitive the price of the bond is, but for very small changes. If you try large changes of, let's say, 10%, this is only approximation. It won't work that well. And now let's try to understand what is the point of this number? What this number actually means? What this 2.85 means? And let's see that on a simpler example. And let's observe just a simple $1,000 bond, face value of $1,000. It has 10% coupons paid annually. So every year you get 10% of the face value, which is $100. So in year 1 you get $100, in year 2 you get $100, and in year 3 you get the face value of $1,000 plus $100. What happens now? What do we need to do? We need to calculate, let's say that the annual rate is 5%. If the annual rate is 5%, present value of each of these cash flows, you can easily calculate it. This 95.24 is obtained by 100 divided by 1.05. This 90.7 is 100 divided by 1.05 to the square. This 950 is 1,100 divided by 1.05 to the third. You add all these numbers, this is the present value of the bond. This is $1,136.16. Okay, how many percent is 95.24 out of 1,136? It's 8.38%. How many percent is 90.7 out of the total present value, out of 1,136? It's 7.98%. How much percent is this out of that, it's 83.63. Now let's multiply these percents with the number of time periods, and we get something like this. Add these two numbers together, and we get 2.75 years. Now the question is, what does this 2.75 means? I told you one interpretation. One interpretation is this bond is as sensitive to the changes in interest rates as the zero coupon bond that would mature in 2.75 years.
So does that mean if I invest this in 2.75 years, after this point you will get more money? Or it will stop?
Don't think about that in these terms. This is one of the common misconceptions about the duration. Just forget that. I mean, you will find this definition in many textbooks, but then when you Google Wikipedia and find the duration, you will see there is one paragraph which says common misconceptions about the duration. And one of the common misconceptions is that duration is time of period until when you basically receive, I don't know, most of your money back or something like this. But this is not true. And let me give you a counter example why this is not true. Imagine 3-year zero coupon bond. Basically, 3-year zero coupon bond has a duration of 3 years. Any zero coupon bond has a maturity equal to the duration. And you know, this simply doesn't hold for zero coupon bonds, because up to 3 years for zero coupon bonds, you haven't received any money. I didn't tell you this definition because it's wrong. So when you read it, and it's probably written in your book, you have this definition in your book. This definition is wrong because it doesn't hold for zero coupon bonds. It doesn't call also for some callable bonds, etc., which we will not even cover in this class. But let's see now, could you, I mean, people, I really have problems with my throat. Please. 2.75 years. What does this mean? Now, I'm telling you the following. If you have a bond with a duration D, let's say 2.75%, if interest rates change for 1%, and by 1% I mean 0.5% up, 0.5% down. If you observe this kind of change, 0.5% up, 0.5% down in interest rates, so if interest rates change, fall for 0.5% or raise for 0.5%, then the price of the bond will change for the duration divided by 1 plus yield percent. To give you an example, everything will be clear. So we have this bond of ours, which we have calculated. It has the duration of 2.75%, 2.75 years. So what happens if what's the present value of this bond at 5%? We have already calculated this. This is $1,136. But what if interest rates change just a little bit up? If they go to 5.5%, they went up for just 0.5%. What happens with the price of this bond? Well, we can calculate the price of this bond. It's very simple. Now, what happens if these interest rates actually go down for 5% to 4.5%? Prices go up. They go to $1,151. And so for how many percents did this change? In the first case, we have the decrease of 1.3%. So basically, 1,121 is 1.3% smaller than 1,136. What happens if the interest rates go down for 4.5%? We see that they change for 1.32%. They go up for 1.32%. So basically, 1,151.19 is 1.32% more than 1,136.16. So for the, you know, we observe here change of 1%, 0.5% up, 0.5% down. And we observe that in this change, the price of the bond has changed in total for 2.62%. And by knowing the duration, we can just easily divide the duration with 1 plus yield and get to this number. You see, the duration tells us how sensitive our bonds are to changes in interest rates. And why is this important? As I told you, you know, what is a bank? What is a bank? Bank is a giant cash flow. You have a cash flow like this plus a cash flow like this. They have many cash flows. Any loan is a cash flow stream. Any bond is a cash flow stream. But almost everything that bank owns can be represented as a cash flow stream. And you know, we know that these cash flow streams can be combined basically in one cash flow stream. If I offer you, do you want cash flow stream on top and cash flow stream in the middle, or just this cash flow stream in the bottom? I mean, you are indifferent because they give you the same amount of money in each time period. And you know, I haven't used any assumption that is relevant to bonds when I calculated the duration. I could calculate the duration of any cash flow stream, of a loan, of anything. It doesn't matter. And you know, I can calculate the duration of this thing over here easily. It doesn't matter whether it's a bond or if it's a loan. And now, government wants to know, what is your duration? You're a bank. Tell me your duration because I don't want to kill you. Because if I kill you, I'll lose the elections. This is the point. So basically, the duration is a measure that gives you a quick and easy measure to understand how risky you are with respect to changes in interest rates. But pay attention, this is an approximate measure. If you try to change interest rates for 10% up or 10% down, the approximation from the previous slide will not work. It won't work. There is a complex math behind it which is out of the scope of this class to show you that, because the duration is basically you are trying to approximate a complicated function with the line. You are trying to approximate the polynomial with the line, but we would have to do some Taylor series expansion. This is for later years of your schooling. Okay. Now we end up here with the duration, and we talk again about the interest rates. Because things in real life are usually a bit more complex than we have done so far. And this is just a bit more complexity to the soup that we have. Just a little bit more. So, imagine the following situation. This is me, this is you. And I need money, I need $100. And I ask you, could you please give me $100? And you say, sure, no problem, but in 1 year from now, you will have to give me a bit more. I charge you some interest. And this interest is, let's say, 5% per year. So, in a year from now, I would have to give you back $105. Then I approach you again, but could you give me this $100, but not for 1 year, but for 10 years? Then you say, sure, no problem. We know how to calculate the interest on 10 years. You just put it to the power of 10. But the question is, should you use the same annual R or not? Should you use the same annual interest rate or not? It turns out that in reality, nobody is using the same interest rates for different maturities. So if you give me money for 1 year and if you give me money for 10 years, you will ask higher interest rate. Why? Because, you know, even though it's the same person, in a sense you would say, you know, the risk is the same. It's not the same risk because, you know, in 10 years from now, I might not be teaching in this school and, you know, I might be on a different continent. Or I could die. Or you could die. It doesn't matter, but the point is there is a higher risk, so you are thinking of, okay, maybe I need a bit higher interest rates for this to accommodate for this risk. And actually, you know, for example, it could be, I don't know, 10% per year, but this is per year more, not in total. Of course that in total you will get 1 plus r to the power of 10, but you also want more per year. So in reality, if you observe actually markets of bonds, we will see that if we invest, for example, in 1 month bond, in bond that matures in 1 month from now, it will offer you a yield or a return of 1% per year. If you invest in a 3-month bond, you will get 1.5% per year. If you invest in 1 year bond, you will get, I don't know, 3% per year, etc. So you'll get more per year as the longer maturity. This is usually the case. There are some special times when this does not hold, and we will talk about that in the next class, when this yield curve becomes what is called inverted. And actually, by plotting these points on a chart, like the one that you have on this slide, you get what is called a yield curve. And actually, if points on this chart are yields of the US government bonds, then it's called the yield curve. If it's something else like IBM, then it's a yield curve. If it's German government, it's a yield curve, etc. So it's some yield curve. But when I say the yield curve, I mean to this chart. And what do I have here? Here I have the maturity on x-axis, and on y-axis I have yield to maturity. I get how much different maturities actually give you. So what does this chart means? Let's observe, for example, one point. If I decide to invest in a 5-year government, US government bond, what does it mean? If I read the point from this chart, that means that if I lock in my money in a 5-year government bond, I would get approximately 3% per year. If I invest in a 6-month government bond, I would get less than 2% per year, etc. You can read it for every different maturity. You can read a different annual rate. And this kind of implies that every cash flow stream cannot be discounted just with a single rate, with R. We can use different R's for different maturities because there are different risks associated with different maturities. And we said larger the risk, larger the discount rate. Okay. So these are what are called zero rates or spot rates. And this is, even if you go to a bank today and tell them, I want to leave my money on my account for 2 years, they will give you a different rate for 2 years and different rate for 10 years. Because for these different periods of time, they can do different things and they can invest in some different things, etc. When they know that this money will be there for 2 years only, you will get lower rate. Or the lowest rate you will get to your current account, where you can basically change the amount on this current account anytime. You get the lowest interest rate on this account. Okay, US government bonds are basically, they are called T-bills if they are from 1 month to 1 year, T-notes if they are from 2 to 10 years, and T-bonds over 10 years. But basically this is the same thing. I mean, there is no difference. They are all US government bonds. They just have different maturities, and for different maturities they carry different names. That's it. Okay. Example. Imagine that you observe the following in the markets. Imagine that in the markets, government bond, 0 coupon rate government bond, no coupons, that matures in 6 months from now. If you buy it today, you will earn 5% on it. If you buy 1 year government bond, you will get 5.8%, etc. So for different maturity, different rates. These are the rates that we observe on the yield curve, okay? Now, imagine you have the following bond, which is as risky as these government bonds. Now this is some government bond which has coupons. Now you want to calculate what's the value of this bond. But now, one coupon matures in 6 months, the other coupon matures in 1 year, in 18 months, and in 24 months. There are different time periods. Now in order to calculate properly the present value of this bond, you have to discount each period with the different annual rate. So these are annual rates. This is not how much you get after 2 years. This is, if you lock your investment for 2 years, this is how much you get annually, okay? These numbers are annual interest rates. Now, just for you not to forget how to discount in continuous time with e to the power of something, I'm doing this example with the e to the power of something. This could be easily done using a different, with this 1 plus r to the power of something. So, what's the present value of this bond? Well, we have to discount each cash flow with the appropriate discount rate. So first $3, how do we discount it in continuous time? We multiply by e to the power of minus RT. So this is 3 e to the power of minus RT. T is half a year. This is this number over here. And this 0.05 is this 5%. So how do we discount this next cash flow? We multiply 3 to the power of minus R times T. R in that case is 5.8%. So this is 0.058 times 1 as a 1 year. And we repeat the same thing for each cash flow. And we get to some number. And this number is actually the price of the bond. And this is how people price bonds in most sophisticated banks. If you go to the top Swiss bank, to the top German bank, to the top US bank, this is how they price bonds. They price them to the yield curve. Every payment, every cash flow stream is discounted with the appropriate rate from the yield curve. And there is no more science in it. I mean, with this, you can price bond in any investment bank or any bank in the world. This is how they do it. There is nothing more sophisticated than this. This is the most sophisticated thing that you can do. And it's not that complex. You just read numbers from the table and multiply. Okay. We have just one more thing to understand. Actually two, but there is one very important thing that we need to understand. And one important thing to understand is what is called yield to maturity of a bond. And yield to maturity of a bond tells you how many percents do you earn if you invest into this bond annually. So imagine you have this bond. And forget about this calculation on the left-hand side of this equality. Just concentrate on this number, 98.39. So this is the amount of money that you would have to pay today for this bond. This is the market price. This is how market is pricing bonds, and this is why this is the market price. Everybody is pricing bonds like this, so nobody is willing to pay no more, no less than this price. And if you check the newspapers, you will see that by pricing of bonds like this, you can achieve very high precision. You can exactly replicate what are the prices that you can buy these bonds for. So if you look at this price, 98.39, my question is, you will hold this bond for 2 years. Let's say you buy this bond for $98.39 and you keep it for 2 years. Now I ask you, how many percents per year do you earn by holding this bond to maturity? This is why it's called yield to maturity. How much it yields till maturity? It turns out that this is a bit complicated thing to calculate. But it turns out that it's actually simple. It's something between simple and complicated. It's very simple. It's very simple if you use a computer or financial calculator, but if you want to calculate it by hand, it's very complicated. And now let me tell you how you calculate this yield to maturity. So this is the price that you have paid today. And then if you discount the cash flow stream of this bond with Y, where Y is yield to maturity of this bond, now you have to find this yield to maturity. Yield to maturity is a discount rate that will discount this cash flow to exactly the market price of this bond. So you would have to solve this equation to obtain Y. And you know, solving this equation to obtain Y is a pretty complex thing. But it turns out that this is a one-liner in Excel. You just have to type IRR off the cash flow stream and Excel, puff, gives you the number. It's as simple as that. So using the computer is simple, but solving nonlinear equations by hand is complicated. We don't know how to solve linear equations that easily. We will see some methods in the later classes, but they are not so important because you can really do it easily using some tools that are. So basically, what is this yield to maturity? Yield to maturity is rate that if you use to discount your bond cash flow, if you discount this cash flow with the yield to maturity, you will obtain exactly the market price. And the market price is the price that you obtain by discounting the bond to the yield curve. So every period you discount with a different rate. Could you please keep the noise level down?
This is the value in the little diagram, no? Like on the slide before, for the 2 years. On the right, bottom right, no?
Yeah, so this is the value of the bond. This is how you calculate the value of the bond. Basically, every person in the market that is trading bonds, every person in the market that is trading bonds, could you please be quiet? I mean, you'll have this lecture on YouTube. You can watch it there. I mean, I have no problems with that. So every market participant will calculate the bond prices by discounting them from these, using these rates which are obtained from the yield curve. And you know, yield curve, you go to the website of, I don't know, if these are US government bonds, you have yield curve at the US Fed publishes yields, or you can find them on Google Finance, Yahoo Finance, wherever. So you can find this table. I mean, these are obviously invented numbers because currently we are living in the times of very low interest rates. Currently interest rates are below 1% on US government bonds. But you can find a chart or a table like this in many places on internet. And then you can price any bond because you know this $3, this is something that is written in a contract. This does not change. So you can calculate the price of any US government bond by using this yield curve. And if you check the current price of such a bond, it will be exactly the same as this because everybody in the market is using the same method. So prices are such that it must be this because nobody wants to sell it for more than 90, to buy it for more than 98.39, nobody is willing to sell it for less. So the prices are these. So now, whether you have obtained this price by checking the market price or you have calculated it, it doesn't matter. It's the same price. And then if you discount your cash flow stream with some y, where y is the yield to maturity of the bond, you find this y from this equation, and this is your yield to maturity. So yield to maturity of a bond, you can observe it from two sides. One side is yield to maturity is the rate that if you use to discount the cash flow of the bond, you will obtain the market price. And you find this y. And you know, this will not be the average number out of these numbers. It's not the average rate that you get. It's not the average rate. It's different. Because this is a nonlinear equation. It cannot be just the average. It's some kind of complexly weighted average or something like that. But the point is, if you observe this y, this is the y that on average you would get over these 4 years in a sense. So if you buy this bond today for $98.39 and you keep it until it matures, you would earn 6.76% on your investment. That's it. Now we have just one more concept to learn about and then we are done for today. And this concept is called par yield. What is this par yield? So I told you that the par value is the same thing as the face value. This is just a different name for the face value. But the par yield is something completely different. So don't get confused. Now, I told you that the yield to maturity is the rate that will make that if you discount your cash flow stream, you will obtain the current market price. Now, the par yield is the coupon rate that will make the value of your bond, if you use discount rates from the yield curve, equal to its face value. If you ask me why is this important, I have no idea, but managers like to know about this. If you start working, they will ask you about par yields and stuff. So you have to know what's a par yield. From the academic standpoint of view, and I actually try to figure out by talking to some of these guys why are they interested in par yield. They were not really good in explaining, so I didn't get it. So I really don't know, but you should understand it. Because it's a really simple concept, and somebody in your future career might ask you, okay, what's the par yield of this bond? Well, the par yield is actually the coupon rate, so it's expressed in percent. Because, you know, when we were talking about this bond, we said this bond has a 6% coupon paid semi-annually. That would mean every 6 months you receive 1/2 of the coupon rate. This is why I divided here by 2, because this is a semi-annually paid coupon rate. So if we solve this equation, we will see, and this equation is easy to solve. It's not non-linear in C, it's linear in C. It's very easy to solve, actually. And by solving C in this equation, you will get that the coupon rate of 6.8% paid semi-annually will make this bond worth exactly its face value, which is $100. It's not a complex concept, but think about it. So this is the coupon rate that makes the value of your bond equal to exactly its face value. And that's it. Any questions, comments, short speeches? Then we're done.